Carnegie Hall for today's capital markets update with Hoist Finance. My name is Ermin Keric. I'm an equity research analyst here at Carnegie covering Hoist Finance. And before we kick off and I hand over the word to Harry Vranjes, the CEO of Hoist Finance, just a few quick housekeeping instructions. So everyone in the room will have the opportunity to ask questions. We'll have a Q&A session by the end of the day that I will host. And if you want to ask a question, you just raise your hand and ask a question, and then I'll repeat it so everyone at the webcast can hear it as well. And then for those of you that are listening in through the webcast, you can actually already try or start to send through your questions in the little text box in the browser, and it will come through to the tablet here next to me. So with that, I think it's time to kick the event off. So Harry Vranjes, CEO of Hoist Finance.
Thank you very much, Ermin. So welcome everyone to this capital markets update for Hoist Finance. It's great to see the room is packed. We've taken in extra chairs. Really good to see that there's so much interest for us and our company. And also a big welcome to those of you who are joining us over the web. We'll try to make this day as interesting as possible so that you get the maximum return for the time you are investing this afternoon. Now, we realize that there's a big breadth of sort of pre-knowledge of Hoist Finance and the NPL industry in the room and on the web, from people who are new to Hoist Finance, new to the industry, to more experienced ones, and then of course on the other extreme it's Ermin, basically, right? Ermin level. So we will try to balance the message. Some of you are more interested in the debt, some of you are more interested in the equity. We'll try to make this good for both of you, or for both crowds, or for everyone. Now, but before we kick off, I would very much, well, actually, normally you see or hear myself and our CFO Christian going through the quarterly numbers every quarter, very much into the details on the various KPIs. Today we will not do that, right? So we will go through. We will start on a very high level, and then we'll sort of go through what's our philosophy, how do we think around the industry, and how have we sort of derived our strategy? What are we doing differently, and how did we get there? Yeah. And then I would also then like to then present all the people who are actually doing this work. So if we start with the management team, could you please stand up? So I'll instead of sending around a mic, I will do this quickly. Starting with we have Miguel, country manager Spain. We have Sarah, country manager Greece. We have Andrea, country manager Italy. We have Katis, our Chief People Officer. We have Enoch, Regional Head of the Growth Markets. We have Cecilia, our Chief Compliance Officer. Simona, our Chief Risk Officer. And then I'll start over here again with, well, Christian, you probably know since before, our CFO. Fabienne Clechat, our CIO, so Chief Investment Officer. Misha, our COO. Here we have Makram, who is our country manager France, and then we have our chief legal officer Pontus. We have one more member of the team, Mateusz, country manager of Poland, fantastically successful unit. He's doing the same thing that I'm doing now. He's speaking on a conference in Wrocław, so he sends his apologies. Now, of course, in addition to this great management team that is doing all this work, we also like to present our board of directors, which we think is the most senior board in the industry, with lots and lots of NPL experience, banking experience, and actually also real estate experience, which is important when we buy secured portfolios. So if our board of directors could also please stand up. So we have Peter, we have Chris, we have Rickard, we have Camilla, Bengt, and over there in the corner, Lars, our chairman. Great. Now, so we will start on a high level and then basically gradually come down to the ground level, where we will go into nitty-gritty of how we do portfolios and how we sort of manage liquidity and capital. So, but without further ado, and to sort of take us up then to 36,000 feet, I'm now going to hand over to Lars Wollung, our chairman, to kick us off. Welcome, Lars.
Thank you, Harry. And just the translation that 36,000 feet means this guy doesn't know much at all these days. So you just bear with him for a couple of minutes and then the program will continue, right? So, but thank you very much. So this is the challenging hour, right? Directly after lunch. So I thought we'd kick off with a little role play so we get going, right? And there are three roles in this place. First, we need a famous European bank with top-notch ESG. And I think Ermin, you look like a banker, so I think you will become the famous European bank. And then we need a debtor. A debtor is someone who has taken a loan, I guess most of you have experiences of being a debtor, but I have a special actor in mind, which is Chris Rees. So here's the debtor. And he has taken a loan from Ermin, 100 euros, a couple of years ago. But then Chris has overspent. Expensive wife and the new pool and whatnot. He can't pay Ermin the 100. So there is a situation here. And then the third role is myself. I have the role of Hoist Finance. So what I do is I go to Ermin and ask him, well, Ermin, this loan of 100, what's the value to you for this loan? And then he will say, well, I tried to get paid and so forth, and I will get paid a little bit, but it's going to take a long time, a lot of costs. It's not my core business. It's a hassle. So when I do all of that into my business case and the net present value, because it's going to take years, this maybe has a value of 5. And then I tell him, Ermin, can I buy it for 10? And then, Ermin, are you happy with the 10 instead of the 5? Yeah, you're an actor, I say. Yeah, you have talent. He's happy. He's happy because 5 to 10, that's 100% increase. Then I go to Chris and I say, Chris, you owe me 100 euros. But here's the proposal. If you pay me 3 euros per year during 7 years, in total 21 euros, I will write off 79 euros and you are free. You're back on track. Are you happy, Chris? Both are happy. Am I happy? Well, could be better, but I paid 10, I get 21 back. So it's a money multiple of 2. So I'm, not disappointed at least. This is the core business idea of what we do. Is this easy? It sounded easy, right? But I know what you're thinking. You're thinking, yeah, well, yes, 21 is less than 100. But isn't there a risk? Will I really how do I know I get the 21 back? So he couldn't pay the admin. So isn't there a risk? How do I know I get the 21? Well, I don't know exactly which of you who's going to get unemployed, a serious disease, a divorce, overspend. I can't say you, but not you. So in a way, the answer is no, I cannot know I will get the 21 back. But I know very well how many of you that will divorce in 7 years' time. How many of you that will get a serious disease? How many of you will become unemployed? I know that extremely well. Hoist Finance idea, we have a strategy or a risk appetite, investment risk appetite document. It's very short. It says no single risk exposure. No single risk exposure. So we are a statistical business, because I don't know whom of you who cannot pay. But if the loan you owe me is so small, so it doesn't matter, because the single risk, your loan divided by my total loan portfolio is 0, then I can play a statistical game. That's what we do. That's how we produce a good enough return on equity without taking some kind of major risk. We don't take exposures. We could double IRR on portfolios if we would take on non-performing loans related to a shopping mall, cinemas, real estate development projects. The IRR would be at least twice as high as the stuff we buy. So why don't we do that? We don't do that because we don't like risk at all. So we have chosen a strategy where we use numbers. So it's a data war. And the player with the most data points and best algorithms to take decisions on those data points wins the game. That's why I know that we will get the 21 back. And the question, is it easy or not easy? I mean, it's just after lunch. Have you ever bought ready-made frozen meatballs? Yeah, some of you have done that. So I bought frozen meatballs. I picked the most expensive package. It was a big Swedish flag, etc. I went home and said, well, believe it or not, but I can assume responsibility for the dinner tonight. Turn the package around and read, was the comment. So I did that, and I said, well, it's packaged in Sweden. The meat is from Belgium. I assumed that I was bringing home meat from happy Swedish cows because there was a Swedish flag on the package. That's how I behave privately. At Hoist, we do not behave like that. We assume nothing. So we know from which city tube system and what part of that tube system this rat meat comes from. And then we say no. So this is very difficult. It's not easy at all. And that's the good thing, because if it's difficult, we can build barriers of entry. We can build competitive, sustainable advantages. And that's what we do. So that's basically what a summary on the 36,000 feet level, what this is all about. And with that, I guess we're done. But I have a few slides too. So let's go through the slides. And how do I click? Okay, so I thought I'd say a couple of words about, what we do, why we do it, and the winning formula, how we do it. So the market itself, debt, credit, is a fundamental value driver of society. There's always going to be a demand for credit because it's efficient and effective. As long as there's going to be debt, there's going to be debt problems that someone needs to handle. So we don't need to create the market. The market is already there, like it or not. The originating bank who takes a credit decision and decides to issue a loan, most of those loans are okay forever. It's just a little fraction, maybe 3% or so, that becomes non-performing in one way or the other. And what can the originating bank do then? Well, then the bank can internally manage the non-performing loans. They can outsource the servicing to someone else. They can sell the loans to someone else. They can keep it but lower the risk level by transferring part of the risk to someone else, like securitization, to take an example. So that's what they can do. There are fundamental drivers for why step by step it's less attractive to internally manage the NPLs and rather externally let someone else manage it. That's what EU, ECB, EBA wants. That's why they do all these regulations to try to stimulate the European banks to not do this internally, but to ensure that they have a top-notch balance sheet and let someone else deal with the problems. So there's regulation. There is also specialization and focus. To do this well, it's very complicated. And I think you will hear a lot about that this afternoon. So if this is not your core business, this is 3% of your business, you're better off focusing on the 97% of your business. So a good part of this business volume will go externally. So if we then are an originating bank and we want to go externally, we have a couple of goals or things we want to achieve. We may want to increase the equity capital, reduce the risk level, reduce operational costs, increase the cash flow, fulfill the ESG objectives, which are growing, and regulation for debt collection is more and more regulated, what you can do, what you cannot do. You need data systems, you need people, you need compliance to focus on that. And if this is 3% of your business, it's a hassle. So you're looking for those things when you decide which external party will you partner up with. You can choose a debt collection service company. You can choose a hybrid company. They do both service and they do service and buy loans and become the owner of the loan. So they are a hybrid. There are investment companies and investment funds that has capital that can buy the portfolio from you, and then they will let a service company service the portfolios. Or you can choose a bank specialized in NPL management. That's kind of the four options you have. We believe, we hope that more and more of the originating banks will select the alternative to the right, because that's what we are. We are a bank specialized in NPL management. And then you can say, well, yes, of course we think like that because we're not objective, right? But what are the arguments for not choosing the first three, but choose the fourth box? Well, there are a number of arguments for why an originating bank in Europe should choose a bank managing NPL, and there are not many alternatives then. Hoist Finance is the major alternative you can choose in Europe. One is that we're a bank like yourself. We live under the same regulation as you do as a bank. That means, by definition then, top-notch compliance, risk, security, internal audit, legal, accounting, treasury. That's a good partner for a bank because we are the same. Stable financing or long-term partnership. This is the only thing we do. We cannot do anything else. An investment fund, they can decide to allocate their capital where the return or risk-return profile is most attractive at this point in time. So they can be around or not be around. Depends on what the alternatives are. We cannot do that. We can only deliver what we deliver. We're nowhere else to go. That means we are a stable, long-term NPL partner for the European banks. Sustainability, I think we'll be hearing more about this afternoon. I skipped that, go to dedication. So we're not a debt collection company. We don't sell services at all. That's the box I call hybrid. They do external debt collection for customers and they own loans. We do not do that. We're completely dedicated. Why is that an advantage? Well, it's an advantage because a hybrid is a very complex thing to run. Because you need to be really good at managing a servicing business, selling services to external clients and delivering that. A big energy company requires you to change your computer system or production system to fit with the mass volumes that E.ON or Vattenfall, etc. have. It's a hugely complex business. Being an investor at the same time requires completely different managers, completely different skill set. It's complex. Furthermore, if an originating bank chooses a hybrid, they are financed with bonds to 100%. Bonds is often there, but maybe not always. That capital is not for sure at all times. At least the cost for the bonds fluctuates a lot, up and down. Our balance sheet doesn't fluctuate like that. I'll come back to that, which means that this dedication, being a bank servicing NPL, produces a very stable long-term partner for the European banks. Portfolio pricing, we may not be the highest bidder, or I guess we lose more than we win. So I guess we are often not the highest bidder at a certain point in time. But over time, we probably are a very attractive alternative, being able to pay good prices to selling originating banks. Because this dedication leads to operational effectiveness and efficiency. And being a bank, it leads to lower cost of capital than most competitors have in this industry. So therefore, we become a very good partner to the European banks. So that's our value proposition to our society. That's what we basically do. But that's what. But then the question is, yeah, but we can do it. But why do we do it? Why is this meaningful? Why is it meaningful to go to work? Why is it meaningful to own the Hoist shares or own the bonds, etc.? What do we provide? What do we contribute to society with? Well, we think we really contribute. We have a platform, which is the bank. On the bank platform, we have 3 core processes: investments, loan management, so investment management, loan management, funding. Investment management, that means we contribute to the financial system in Europe. Back to the, why do we need debt? Why does that create value? It means you can buy your apartment not when you're 50 years old, but actually when you're 29. That means you can start a consulting company because you get the working capital. Otherwise, you could not have started, etc., etc., etc. We contribute to the financial system by being an NPL investor. Loan management is about financial health on the people level. We help people get back on track who have overspent or have had been in trouble one way or the other, and we help them to pay off debt, write off debt, and the degrees of freedom we have to structure that is much higher than an originating bank, which can't go to the client and say, well, if you can't pay 100%, can you please pay 20%? That's really hard for an originating bank to do. We have, when we become the owner, we have much more degrees of freedom. That's where the value proposition for society is. That's why we suggest we have a meaningful why. I will not go into further details. That Harry is going to do that in a minute. The winning formula, well, with increased risk, you get typically increased return, or at least you should ask for that. We're trying to be an alternative where we have a low risk level, but produce a decent return on equity with a low risk level. How can we do that? How can the risk be low? Because we differentiate ourselves compared to the hybrids by seeing us as a balance sheet business. The horse for us is the balance sheet, and the wagon is the P&L. Most of our competitors, at least up until recently, they've been running the other way around, so that the P&L is the horse, and then there is a balance sheet as the wagon. It's almost like the balance sheet is a black swan coming in. Oh, there's a balance sheet too, because you've been looking at EBITDA, adjusted EBITDA, cash EBITDA, etc. And then the balance sheet comes and runs over the horse. We see ourselves as a capital-heavy NPL management institution. The balance sheet is what drives the business and therefore drives the risk. Our balance sheet looks like this. You know, you have the asset side, you have the liability side. If we go through them, start with asset side, we have an NPL portfolio. As I said before, there is 0 single risk exposure. When this board joined in February 22, we had single risk exposures. We had loans in a shopping mall, in 9 cinemas, in another country, etc., etc. We have sold it off. Everything is sold to book value or higher than book value. It's completely cleaned. 0 single risk exposure. Furthermore, we buy from different qualified banks in several countries. So the portfolio is diversified layer by layer by layer. An extremely 27 or so billion SEK portfolio, extremely diversified. The second item we have on our balance sheet is liquidity, or next to liquidity. It's type of papers that the credit risk is basically that the state of Sweden would go bankrupt. It's that type of minimal risk. No goodwill. We're a regulated bank, not allowed to have goodwill. That needs to be deducted from capital, as you all know. No goodwill, just hard earnings, high earnings density papers on the asset side of the balance sheet. And then if you turn over to the liability side, of our liabilities, 70% is savings accounts. Only private persons can save with us, not companies. They cannot save more than what the state guarantee is, insättnings guarantee is. So even if they want to, we say no. We have 120,000 customers on the savings side. Extremely diversified. Sweden, Poland, Germany, UK, Austria, etc., etc. Extremely diversified. Currencies that matches the asset side, and not perfectly, but we are going in that direction. So several countries, many small savings accounts. Completely diversified. No single risk exposure at all for 70% of the liability side. And then we have bonds, and there we try to diversify that too in terms of time and amounts. So it's not one big bond that comes to an end a certain date, but we spread it out. And the last 18 months, we got really good bond investors which we are really happy about, that want to join and support us. The last tap we did was very small, but still it was not eight investors, so not one, 8 investors, really good investors, etc. So it's also diversified. So the whole balance sheet then is diversified to a very granular level, and that means a very low, in reality, risk level. I think Christian and Harry and also Fabian will come back to the risks. So I think I'll skip that for now. But as you see to the right, we suggest that most of the risks are really low. We have a cybersecurity risk, I guess, not any specific for Hoist Finance, but society as a whole has a cyber risk. We take that very seriously. We spend a lot of money and effort in doing everything we can to be protected. So far, so good. Nothing has happened. We also bring IT home from being outsourced to India. We could get out of that contract this year, so we did. We're building it up internally. So we've done that. A super grip on IT. And we are in a data war as a business. So of course, super grip on the IT side is important for us. So that was the risk side. And then we have the return side. And then I guess the cost of capital is the key sustainable competitive advantage. And here's the WACC formula. As we all know, this is what part of debt can you have? What part needs to be equity? And then it's the cost of debt and the cost of equity. And since we are a bank with all the regulations that means, so no goodwill and no this and that, risk scenarios sent to the Swedish FSA, etc., 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 it means our debt to debt plus equity level should be very high compared to most other colleagues in the industry. That hasn't really been so, but rationally, logically, it should be that way. And of course, as we all know, why that is good for the WACC is if this weight is high, it means you multiply that with cost of debt, and cost of debt is always lower than cost of equity. So you want to have a high enough gearing level, basically. And we should have a leading gearing level in the industry over a longer period of time. Because we avoid so many of the financial risks that the others do not do. The cost of debt for us is less than half of every competitor we have. So a high weight times a very low cost of debt means a low total number. A low weight, and then a cost of equity is at least same as all the others. But it means a WACC that is less than half of what any competitor has. And that's how we create return on equity. Well, you can turn this formula around saying, we buy for higher and higher IRRs. And then if you solve for cost of equity, it means the cost of equity can grow. But when this one grows, this doesn't take so much of that growth. It lands over here in terms of return on equity, where we've gone from basically 0 to plus 15%, and we're working hard to improve. So in summary, the winning formula is to maintain a structurally low cost of capital and combine that with excellent loan management operations. And that's basically the core of the winning formula. With that, I'll hand over to Harry to take us to a concrete level.